Basic Appraisal Principles, page 186. Types of trusts. There are three types of trusts. Living trust. A living trust is created by the trustor to give authority to another to manage the trustor's assets when the trustor is incapable or requires other expertise to manage the assets. It is commonly used by married persons to designate co-trustors and beneficiaries. In a living trust, the trustor is the likely beneficiary. This type of trust can be revocable or irrevocable, depending on how the trustors had the trust written. Testamentary trust. A testamentary trust is established through a person's will as an avenue to administer the estate after the death of the trustor. In general, a testamentary trust is most commonly used by someone who has significant wealth and has concerns that the beneficiaries will not have the capabilities to manage such funds appropriately. Land trust. Some states allow landowners to create land trusts. A land trust is a revocable trust that holds title of real estate, primarily created due to the following benefits: for privacy and anonymity. That's a hard one to say. Anonymity. There it is. Anonymity. When property is held in a land trust, only the trustee's name is made public, not the beneficiaries. To avoid encumbrances, the beneficiary's interests is considered personal property. Therefore, a lien cannot be placed against it. For ease of transferability, by simply changing the name of the beneficiary, the trustor changes ownership. In a land trust, multiple beneficiaries can be named, and these beneficiaries can be individuals or corporations. Upon the death of a beneficiary, the trust transfers to the deceased's heirs. Real Estate Investment Trust, REIT. A real estate investment trust is established when a group of at least 100 investors form a trust and purchase certificates of ownership in the trust. The trust then invests in real estate and real estate mortgages and distributes any profits to the investors. The trust is unincorporated, so it avoids corporate taxation. A trust is only taxed on its retained earnings. Most of its income is distributed to the investors to avoid any significant taxation to the trust. The profits distributed to the investors are taxed only as ordinary income to the individual investors. With a REIT, small investors can take advantage of big investment opportunities by pooling their resources. Even though a REIT must have at least 100 investors, the entity has sole ownership of the property. Extra notes, big time stuff. Unincorporated, like syndicate. Page 187. Common interest ownership. Certain types of real estate developments are structured physically and legally to combine sole ownership with co-ownership. These developments, which are sometimes called common interest communities, include condominiums / conversions, townhouses, cooperatives, and timeshares. The development and sale of these types of properties are regulated under state and local laws. Condominium and conversions. The term condominium was coined to describe an ownership situation in which people have common control or dominion over property that is jointly owned. When purchasers buy a condominium unit, they receive ownership of the individual unit in severalty, sole ownership / fee simple interest, plus an undivided interest in the condominium's common elements. They share ownership and use of the common elements with the other unit owners as tenants in common. The common elements, sometimes called common areas, typically include the grounds, parking lot, lobby, hallways, elevators, and stairs. Shared structural elements of a building, such as the roof and exterior walls, are also common elements. In some condominiums, the common elements include recreational amenities, such as tennis court or a swimming pool. Residential condominiums are popular in many urban and resort areas. Condominium ownership may also be used for commercial or business properties, such as office and professional buildings, medical clinics, shopping centers, or recreational developments. Typically, to establish a condominium, whether it's new construction or a conversion, the developer records a condominium declaration. The declaration states the name of the condominium and provides detailed information about the property, such as the legal description of the land and a plat showing the location and dimensions of the improvements, along with the boundaries and floor plan of each unit. In addition, all the common elements and limited or special common elements are described in the declaration. A limited common element is any common element or area of the property that is reserved for the use of a certain unit or certain units to the exclusion of other units. Some examples of limited common elements are assigned parking spaces, storage units, and balconies. The declaration specifies which unit or units each limited common element is assigned to, the undivided interest each unit owner holds in the common elements, stated as a fraction or percentage, is listed in the declaration, along with what fraction or percentage of the common expenses each owner will be required to pay. The extra notes. Condom units, Condom means common. Shunned upon back in the day. More value if on the end there is a difference. I think they're referring to if the condos is an end unit, so it has like no other neighbor. If it's in the middle, it's less valuable. If it's at the end, it's more valuable. Tip: have a annual real estate checkup every year. Cost approach isn't work or worth a crap in older homes.